Hey everyone, today we're jumping into a classic, and I mean classic, pattern in technical analysis, the rising wedge. You know when you're watching a stock just climb, and you can't help but wonder, when is this thing going to run out of gas? Well, this explainer is for you. We're going to break down exactly how to spot this powerful signal, and more importantly, what to do when you see it.
So, here's our game plan. First, we'll talk about why this pattern is such a critical warning sign. Then we'll get into the nitty-gritty, the anatomy of the wedge itself. From there, we'll get practical with a step-by-step trading playbook, look at it in action with a real-world example, and then wrap up with some really important best practices.
All right, let's get right into it. One of the trickiest things for any trader is figuring out when a strong bullish trend is starting to lose its mojo. The prices are heading up, everything on the surface looks fantastic, but underneath, that buying pressure might be quietly fading away.
And that leads us to the million-dollar question, right? How do you actually get an early warning that this beautiful uptrend is on its last legs? How can you tell that the climb is getting tired before the price takes a nosedive? This is the exact problem that chart patterns are built to help us solve.
And the answer we're diving into today is, of course, the rising wedge. The best way to think about it is like a major clue the market is leaving for you on the chart. It happens when the price gets squeezed between two trend lines that are both pointing up, but they're also getting closer and closer together. This tightening, this compression of price, is a classic signal that the trend might be about to flip and head south.
I absolutely love this metaphor. The rising wedge is basically a yellow traffic light for an uptrend. It doesn't mean you have to slam on the brakes and sell everything that second, but it is a very clear signal to slow down, pay attention, and get ready for a potential stop, or in our case, a reversal.
Okay, so let's move on and really dissect this thing. To trade this pattern, you've got to know exactly what you're looking for. So what are the key ingredients? What makes a rising wedge a rising wedge?
So these characteristics, they tell a story of a battle between buyers and sellers. It all starts in an uptrend. You spot those two converging lines. But here's the crucial part. The lower support line is steeper. What does that mean? It means the buyers are still pushing the price up, but they're not making as much progress as they used to. Each new high is just a little less impressive than the last. It's a textbook sign of exhaustion. And while this is happening, you'll often see declining volume. Then, the whole thing is confirmed when the sellers finally win the battle and the price breaks down below that lower support line.
And this brings us to volume. This quote nails it. Think of volume as the fuel for a trend. A healthy, strong uptrend needs a lot of fuel, a lot of volume to keep pushing higher. So when you see the price continuing to creep up, but on less and less volume, well, it suggests the move is running on fumes. The buyers are getting tired, and there just isn't enough gas in the tank to keep climbing.
Now, here's a little twist you gotta know. The rising wedge can actually show up in two different situations. Most of the time, it's a bearish reversal pattern you see at the very top of an uptrend. But sometimes, it can also act as a continuation pattern inside a bigger downtrend. In that case, it's just a weak little bounce, a bear market rally before the primary downtrend kicks back in. The shape is the same, but the context is everything. All right, enough theory. You've spotted the pattern, you get what it means. Now what do you actually do? Let's get down to business and walk through the playbook for how a trader can strategically act on this signal. It really breaks down into a clear 5-step process. 1. You identify the pattern. 2. And this is so important. You wait for confirmation. Don't jump the gun. You want to see the price actually break and, ideally, close below that lower support line. 3. You enter your short position. 4. You immediately manage your risk with a stop loss just above the last little peak inside the wedge. And 5. You plan your exit by setting a price target. Okay, so how do you figure out that target? Well, you've got a few tools in the toolkit. The classic way is to measure the height of the wedge at its widest point, and then just subtract that distance from where the price broke out. Pretty simple. Some folks like to use Fibonacci levels for a more nuanced approach, but honestly, a really practical way is to just look left on the chart. Find a previous area where the price bounced up from. Those old support levels are often natural places for the price to head towards.
Theory is one thing, but seeing this play out in the wild really makes it click. So we're going to look at a perfect textbook example of a rising wedge that formed on the Vanguard Financials ETF, which trades under the ticker VFH.
So here's how this trade unfolded over about 5 months. It all started back in October 2022. The price started making those higher highs and higher lows, but you can see them getting squeezed into that narrowing range. And just like the textbook says, as this was happening, trading volume was slowly drying up, that running out of gas signal we talked about. Then, March 20th, 2023, that was the moment. We got the clean breakdown, the confirmation, and believe it or not, just 1 week later, the target was hit.
So what was the price target? Using that height projection method, the calculated target for this setup was $74.09. And boom, on March 27th, the market hit that price almost to the penny. It's just a fantastic example of how this pattern can give you a clear roadmap for a trade from start to finish.
Now, before you run off and start searching for rising wedges everywhere, we have to talk about some crucial best practices. Look, technical analysis isn't a crystal ball. It's a tool for putting the odds in your favor. And using that tool well means having context and discipline.
So here are 4 principles to always keep in mind. First, look at the big picture. A wedge that breaks down when the entire market is selling off has a much higher chance of working. Second, time frames matter. A pattern on a daily or weekly chart is way more significant than one on a 5-minute chart. Third, don't trade in a vacuum. Use other tools like an RSI or MACD indicator to confirm the signal. You're looking for signs that momentum is fading even as the price creeps up. And finally, patience, patience, patience. Wait for a candle to actually close below the trend line. It'll save you from getting faked out.
And really, all of this boils down to the single most important rule in trading: risk management. Before you even think about placing a trade, you have to ask yourself, does the potential reward justify the risk I'm taking? A good rule of thumb is to look for at least a 2-to-1 ratio. Is your potential profit at least double your potential loss? If the math doesn't work, you just walk away. Simple as that. There will always be another trade.
So we end with this final, really important question. Is a chart pattern like the rising wedge a prediction or is it a probability? Well, the best traders on the planet know that nothing in the markets is a guarantee. They use these patterns not as crystal balls, but as tools. Tools to find scenarios where the odds are stacked in their favor. The rising wedge won't tell you the future, but it can absolutely help you make smarter, more informed decisions in the present. Thanks for tuning in.